Kenya's debt profile has been elevated from moderate to high by the International Monetary Fund due to the impact of the COVID-19 on the economy. This follows the disbursement of 78.7 billion shillings last week as a concessional loan to the country. The funds are set to be used in helping Kenya's economy cope with the shock brought about by the COVID-19 pandemic. In an assessment on its website, the lender indicated that it agrees with the government's fiscal and monetary response to the pandemic, allowing for its increased spending. The increased risk of debt distress now indicates that the country's debt sustainability has steadily risen, thus increasing debt distress. Putting a plate of ugali on the table is said to be more expensive following a pronouncement by millers that they will not be importing maize before the end of this month. The Cereal Millers Association says that following a decline by Treasury to extend the duration for millers to import maize at a lower tariff, a one-month void of stocks is set to be created. In a letter to the Agriculture CES, Peter Munya, the association's chairman, Mohammed Islam, says that millers sought an extension of the window, allowing them to import at the lower tariff, but have been unsuccessful. Islam says that cancelling of a contract which was set to see imports from Mexico come into the country has already cost the parties involved over 100 million shillings. Oil marketers on their part in the country are calling upon the Energy and Petroleum Regulatory Authority, EPRA, to come up with a mechanism to cushion them from the drop in demand for petrol and diesel. In a letter directed to Petroleum CS John Muñez, the marketers are seeking that EPRA adjusts the cost of 40% of cargo brought in during the April and May pricing cycle and include it in the next price review. The letter, signed off by Martin Kimani, the chair of the Supply Coordination Committee, also seeks that EPRA excludes the 2 April price fuel in the next review and also craft measures to curb their losses. The move is set to buy marketers time to deplete their stocks before the authority lowers retail prices. This happens as global oil prices continue dropping as the commodities demand dip following decreased consumption. The Kenya Electricity Generating Company, KenGen, has shortlisted 5 bidders for the construction of the first phase of the Olkaria 4 power plant in Naivasha. The 140-megawatt project entails development of a geothermal power generation plant on a build, own and operate and transfer basis. The successful bidder will enter into a joint venture with KenGen and will finance, construct, own and operate the power plant and the associated facilities and transfer the project back to KenGen at the end of the operational term. This will be the first public-private partnership project to be developed by KenGen under the PPP Act of 2013 and the PPP regulations of 2014. In the past, KenGen has financed its power projects through syndicated debt funding sourced primarily from multilateral and bilateral institutions, infrastructure bonds, own equity and state-to-state concessionary funding. This project is part of the national project to generate 560 megawatts of geothermal power and the public-private partnership framework.